The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. Lovely to have you with me today. How's the volume, folks? Can you hear me all right? Here we are. Look at Mark. Oh, Mark's on it already with that first man up. Question mark. Very interesting man. Yes, well, he can hear me all right. So can the others. That's grand. Good to hear you. Well, we have a whole lot to go through today, folks. So firstly, let me welcome each of you and say how nice it is to have you with us. All our usual members, and we have some ladies with us today as well. We've got Adrian down in Adelaide, Albert, Andrew, Carol. Welcome, Carol. We're always very pleased to have ladies with us. Chase, my non-smoking friend. Eric Trotter, there's a voice from the past. Eric, how grand to hear from you, my friend. In Brisbane, in a decent time zone. Well, isn't that wonderful? Let me know if you're coming down our way. We'll get together and have a nog. And Janet, lovely to have you with us. John, Justin down in the Hunter Valley. Marty, Matt down in Melbourne. Good to hear from you, my friend. Haven't talked to you for a long time. Michael Peel, the man over in Panama. They're from everywhere. Murph, good to have you with us, my friend. Peter, yeah, Philip. Suhasini, another lovely lady who's done a Daniel Code tutorial. Okay, folks, so great to have you all with us. Sue Lee up in Cairns, nice to have you with us, Sue. Okay, so let's see what's happening over here in the busy world. Boy, it's a great time to be alive, isn't it? You've got election in the States for president next year. Much excitement starting already. You've got an election for the federal government in Australia in about 12 days, which is going to be lead to some very significant changes for us, because I think the Labor Party, the equivalent of the Democrats, if you like, it's the more socialist of our two major parties, both of which have a great tendency towards socialism. I think there are certainly to get in. They're going to raise taxes even further. Of course, one of the joys of socialism is that a lot of the things that are done in the name of socialism are very good. For example, we have a universal healthcare here in Australia. Anyone can get medical treatment. There's some argument about very exotic treatments and how available they are on the public purse, but essentially everyone gets free medical treatment. And we have another thing called the NDIS, the National Disability Insurance Scheme, which is really just paid for out of the public purse. Massively expensive and massively good. Very, very good, very desirable piece of legislation. But the reality of socialism is that someone has to pay, and that's always the taxpayers. So Australia must be very close to the highest taxing country in the OECD, and it's going to get it's going to be even higher once our friends from the Labor Party get into government. So that's exciting. In the States, you've got tariff arguments going on. You've got a bit more pressure today because the US has seized a very large coal ship, 17,000 tons. It's a big ship belonging to North Korea that has been used to dodge the coal embargoes, which United Nations imposed in last year. I think might have even been 2017. So it's on its way to the States now. It's been confiscated by the US government, and that's going to make Kim Jong-un even less happy than he was yesterday. So lots of things happening, lots of drama, lots of excitement. America's turning up the wick on Iran and causing lots of pressure points. So we do indeed live in interesting times. So let's see what we've got for you today that we can talk to you about. Let's get on to our next page here, which should be here somewhere. There it is, and there we are. So, funny name for a webinar today, isn't it? Ring around a Rosie. It's an old English nursery rhyme, American as well. It was recorded in some writing in the States in 1840. So it's been around a long time. And we're not all that interested in roses, apart from the fact they're very beautiful, but we do like the "we all fall down." And I think there's increasing risk of that in markets, and I've managed to retain bullish while also having great fun trading the pullbacks since the 2009 lows. But I really think that we're reaching an interesting stage now with markets. Basically, let's move on a little bit before I run way ahead of myself. There is a point in all markets at which we have a heightened probability of a failure of the market. And I think that we're nearer that point now than most people realize. If we move away from the simplistic view of markets, which is that most of the important markets are at all-time highs or very close to it, and we look at the angular view, which I talked to you about a little bit at the last webinar, where we're using Daniel Code trading channels to give us a view of what's really happening. Is we're taking out the major trend, and we're looking at what happens if we reduce that or remove that major trend. We start to look at charts on the angle, and I'm going to show you today that historically that's been a very, very important method of analysis, although I've actually never heard it spoken about apart from me. So, as usual, and T-bonds in a very important place as well, which you're going to talk about today. We've also got some of the second-tier currencies, Canadian dollar, the Aussie dollar, particularly those currencies that are very market-sensitive to import-export flows and what have you. And we've got a massive slowing down of export around the world. The Baltic Dry Index, which is the index that measures the amount of work that the shipping, large, heavy-duty ships are doing, it's collapsed to 5-year lows. That's certainly got to be telling us something. So let's look a little bit, first of all, at what these angles are. So the angles are a basic tool of traders, and you're actually using them all the time without maybe being so aware of them. I mean, horizontal lines are 90-degree angles. That's what we use to delineate support and resistance for price. Vertical lines are a 360-degree angle, and they're used to mark time cycles on the perpendicular axis. Other angles, we can use angles across a chart. Will have both coordinates for the x-axis and the y-axis, so they're marking both price and time, and they can have patterns to them. They can separate or converge. A lot of technical analysis is done with wedges, and a belief that a wedge that's getting smaller and smaller, when those trend lines are broken, it will lead to a release of energy, and there's some truth in that. But the most powerful of these angles are those that connect two or more points on a chart and forecast a third point. These are typically fourth or fifth seal angles, and over the years I've shown you enough of that to you know that they really do have some explosive capabilities. This chart now is T-bonds. Just let me look at the audience view, make sure it's changed for you. There it is. Now, anybody who's been with me for a while, you've seen this chart for years and years and years. This chart starts in 2000, and I've shown it to you many times over the last 10 years, well, 11 years now for the Daniel Code, isn't it, that we've been doing this. And you can see that it's got fairly busy over the years. But just cast your eye to the blue lines on the angle, and the heavier, the darker line, that's the median or the mean of the chart. And then you can see it has two channels above it with the lighter blue lines, and two channels below it with the lighter blue lines. Now, the important point to remember is that at least some of you, those of you who attend my webinars, have seen this chart many times over the years. And nothing has changed with it since it's been updated. And the last update is in October 2016. November 2016 is the last time that blue line, the deeper, thicker blue line, was moved. And what it's done since then, if you look, it's the high that came in September, October 2016. That is two standard deviations from the mean. That's two lots of blue lines, if you like, or two channels above the mean. Now, they're not normal mathematical standard deviations. These are Daniel Code standard deviations. That is, they're using one of the dominant Daniel Code ratios to create the standard deviation. But having had that, and we had that top right at two standard deviations for the mean, this thing's become an absolute fulfillment of Newton's laws of motion, that any action has an equal and opposite reaction, which we know that applies to objects in motion, and often enough it will apply also to trading charts. But having gone to two standard deviations above the mean, look where it finished up, two standard deviations below the mean. And that recent low, which looks like it's May-June 2019, came right at a 59 cycle from the old March the 10th, 2010 high, and it's 1.5 times 59, so it's 89. That's 1.5 cycles. It shall be for time, times, and half. That's the and half, which had perfectly identified the low bar there. It's actually the bar that starts to move up. It's one bar past the actual low. All these time charts are accurate to plus or minus one period only, and that's a very, very significant move, particularly as the rally out of that low is now hitting resistance at one standard deviation from the mean. So you cast your eye back to this chart starting in 2000, the pattern, the price pattern we're seeing now doesn't look so extraordinary unless you've got the Daniel Code trading channel on it. But if you have, and you say this has gone from two standard deviations above the mean all the way down to two standard deviations below the mean, which is about a $40,000 move per one US T-bond futures contract. It's a massive, massive move. And now it's getting resistance from one standard deviation below the mean. That is a different pattern entirely to anything we've seen since 2000. If you just cast your eye over it, you can see early on the market holding the mean, then it's dropped down to one standard deviation below the mean. It goes on to test that support line, that support channel, 1, 2, 3, 4, 5, 6 times, eventually taking off in February, March 2014, and roaring up to two standard deviations from the mean. So now you have, for the first time since 2000, you have the UST bonds, the primary instrument of funding for the US government, now off at the bottom of its Daniel Code trading channel and finding resistance at 1 standard deviation from the low. And that is the complete opposite of any pattern we've seen since 2000. What does it mean? Well, I don't know what it means. You can see it's got a big note on this saying raising rates with a big arrow against it that took us into about March, April, looks like about November 2015. So these charts, all of these bond charts are the inverse of what's happening. In other words, if this chart goes up, the interest rate is going down. If this chart's going down, the interest rate is going up. So we had that note of when the government said it, the Fed said it was raising rates, and that had no effect for 7 months. This is a 24-day chart. This is effectively a Daniel Code monthly chart, if you like. The announcement, in fact, the fact that the Fed started raising rates took took 7 months before it actually impacted on the chart, because the chart continued going up, ergo interest rates were going down. Well, you had a massive run down on this chart. In other words, a massive run up in interest rates, or a significant run up in interest rates. Now we've got the inverse with the market trying to rally, that is, trying to lower interest rates again, and having real trouble with that. Very interesting, but the thing to rely on with this chart, why I'm making such a point about it, is that you've seen this chart so often. You've seen these numbers on this chart time and time again. This is not something that was designed for any other purpose, but it does show you the amazing accuracy of these Daniel Code trading channels once you get the setup right. Okay, let's move on now. And here we are. Wait for this to change for you. This slide is called the Angular Man. All I'm showing you here, this happens to be a natural gas chart. What I'm showing you here is the accuracy of these various price levels that we use at the Daniel Code. And you can see that they're a horizontal line. That's an angle. That's a 90-degree angle. And you can see how powerful these support and resistance levels have been. So there's one way of being an angular man, or an angular lady if you prefer. Now let's have a look at this a little more detail. That there's 500 theories about charts, what they do and how they should be interpreted. The only objective truth to any of them, in my view, is history. And if we are propounding a theory in the use and reading of charts, we need to go back in time and say historically what are the various ways the market displayed these conditions that we're concerned with. So this is the S&P Index, and on here this is a 6-day chart, and what we're looking at here is the .com top way back in 2000. And what you can see here, as the market's moved along through there, it's bounced between 1 standard deviation above the mean to 1 standard deviation below the mean. It's made its final top at 1 standard deviation above the mean. It's then gone down. It's tried to hold support at 1 standard deviation below the mean, and eventually that's failed. That's its failure point. Let's move on and look at a longer version of that. This is the same chart, but we're doing it now. We're looking at it all the way back to July 1996. This is a very, very long-term chart. The important things you can see here is it starts off running around the median or around the mean either side, 1 standard deviation above, 1 standard deviation below. And then in or around October 98, you have the break. This was actually a very, very serious crash at the time. For those of you with long enough memories, it was considered a real market crash at the time, and it ran through. It went down to 3 standard deviations below the mean. It broke through the 1 standard deviation from the mean, and it found support eventually at 3 standard deviations from the mean. From there it went on. The end of the world crash in '98 turned out to be just a major, major correction, and it goes on. It gets back to its normal methodology of holding the median up to the 1 standard deviation from the mean, down to the 2 standard deviation from the mean. And have a look up here, which is up around April, May, June 2000. This is the time when this market hits 1 standard deviation from the mean. That's confirmation of the trend on the angular version. In other words, it has to do that to continue the trend upwards. It then goes down and it goes sideways for a number of months on 1 standard deviation below the mean, and that's where it fails. In other words, right in here, this looked like it was all pretty healthy, other than on this particular type of chart, but this is the failure right here. It needed to get back above the old high, not just on the lateral or sideways number, but on the angular number as well, and that's the failure point. Let's have a look at this. This is a semi-log version of the big S&P index as well. Semi-log is a mathematical technique that's used to give enhanced visibility to moves in the market that are made small or irrelevant because of the effluxion of time, the bigger bars that come as this index matured. These moves back, in 94, 95, these ranges were nothing like anything like they are now. But if you go to a semi-log, you can see how devastating that 98 crash was. It was a very, very big deal. Then this gives you the same pattern that after it continued to make its high, it tries to rally, it fails at that point. This is actually the failure point right in here. Let's continue. Get rid of the semi-log. Let's have a look. This is the rundown from the .com top down to the low in '02. Now, why am I harping on about this? Because I'm trying to show you a similarity of patterns that goes on all the time. Start by following your eye down with this major line, the dark blue line, and its extension. That's the median or the mean. Look at this classical move here. This market starts, like they all do, working their way around either side of 1 standard deviation, around the actual mean, goes up to 1 standard deviation above, 1 standard deviation below. Then you get the breakdown to 2 standard deviations from the mean. Rallies up to 1. Does it again, 2 standard deviations from the mean. This time tries to get up to 2 standard deviations from the mean, obviously knows about Newton's law, and doesn't do it. This then becomes the failure point. Have a look at this, these 2 lows here, culminating in the November 2002 low. This is 1 standard deviation from the mean above where it needed to be. This is the boundary, 2 standard deviations from the mean. It's hit once there. This market needed to take out this dotted red line, the bottom one, to confirm the downtrend was in place, and it failed to do that. It got support 1 standard deviation from the mean above it. In other words, the exact antithesis of what we were talking about before with the S&P making a top. So on the angular view of markets, that's a failure to confirm, and that's what sets up the long rally that eventually proves that as a low. Okay, let's move on. We've got some more here. This is the run of the S&P from its 2002 lows all the way up to the 2007 high. before we got the 2007-2009 crash. And look at this thing, exactly the same pattern again as we're seeing right now. Here's your median. Where does this start off? Well, this is 2 standard deviations from the mean, back up to +1, -1, wanders around trying to hold, but weaker, can't hold the mean, so it holds the next line down. That's -1 standard deviation from the mean. Gets support at -2 standard deviations from the mean. Up it goes, recovers 1 standard deviation from the mean, and then gets up all the way up to here, 2 standard deviations from the mean. Now, this next high, this is the 2007 high. It's a higher high. That's a new high for the S&P. But if you look at it in terms of the dotted red line, which is the extension of 1 standard deviation from the mean, it's a failure. It needed to get at or past that dotted red line to confirm the uptrend was still intact. And when it fails to do that and takes out the next lows of any break of the Daniel Code trading channel, that tells you that's a non-confirmation of the uptrend. And as early as a matter of weeks, these 6-day charts, they're effectively a Daniel Code weekly chart, if you like, a matter of weeks after the all-time high in 2007 told you that was a significant market failure. How significant? We didn't know, but we soon knew because it got support of the 2 standard deviations from the mean, which it hadn't broken since 2002, early 2003. It broke that, and that's when the real rout started to happen. And I think you're very close to seeing something like this again, which is why I'm trying to get your head thinking that way. So this is the Aussie US dollar chart. Why am I showing you this chart? Because it's slightly different. Here we're looking at the vertical lines, the 90-degree angles, if you like. The principle's all exactly the same. These just happen to be 90-degree angles. These are our price support and resistance angles. And this is a 12-day chart. But what I want to draw your attention to is this great big spike here, which is in December 2018. Those of you who've been trading Forex for a while will remember this day. It was a rather weird day, and the Japanese market didn't open when it was scheduled to, and there was a panic flash crash in a great number of markets, including the Aussie. And it was one of those totally unscripted, unscheduled, why did it happen? No real explanation. But the Japanese market didn't open, and it resulted in this little mini flash crash, which was a pretty big deal at the time. The point I'm making is that we had that number of 6779 down there on the black line. It's not as accurate as I would have expected it to be, but this was a huge, unexpected panic move, and the fact is that's where it stopped and reversed straight back. So these angles are vitally important. They are controlling what markets do all the time. And that's why all these angles are relevant. This is just UST bonds, another one. I'm just showing you that the strength of that move down, $40,000 per one futures contract from the high to the low. Massive move, unscheduled, unpredictable move. Not worrying people much, but you should be, because this is a total change of the pattern. Support, historical support all the way back to 2000 has now become resistant. In other words, this market has flipped on its head. This is going to be a big player in whatever's coming down the track. And, you know, what is coming down the track? Well, at the moment, the market is stuck in a total argument between a record strong U.S. economy, terrific figures, GDP, very good, new job employment, very good, average wages up, very good. I mean, it's a very overused expression, the Goldilocks economy, which Kudlow used to love on on Squawk Box, didn't he? Oh, it's the Goldilocks economy. Well, it's a real Goldilocks economy now. On the surface, is it really? Well, it gets pretty scary when you hear the president saying the tariffs that China's been paying are good for our economy, are helping our economy. In other words, he's looking at tariffs as a shopkeeper would, cash in, cash out. And I'm an expert on tariffs because many years ago in another life, I had a big rubber company called NAM, North Australian Rubber Mills, up in Brisbane, Queensland. It's a public company listed on the old Brisbane Stock Exchange, it was then. And what we did is we imported rubber and all the chemicals and what have you, bulk bales of rubber, and made conveyor belting and industrial tubing, heavy-duty rubber usage where it's out of it, very labour-intensive. Had about 700 people on the payroll. Would drive you mad dealing with the unions. But as well as that, we imported shoes for some historical reason that I'm not aware of. The tariffs on shoes used to change just about as often as you change your suit pants, I suppose I should say. So I had many years dealing with tariffs. The whole point about tariffs is that while the president, your president, is saying this is great for the economy, it goes straight on our bottom line. Yes, it does, but the reality is that the Chinese are not paying those tariffs. The people who are paying those tariffs are the importers. They're the people who are liable for the tariff. To that extent, it's a tax. Tariff is a tax on the importers of those products, and it's a transfer tax that transfers wealth from the importer to the government. And in that regard, it's got a socialist aura about it, hasn't it? But it doesn't mean it's all bad, but it's certainly not all good because it's actually reducing profitability for American businesses. These tariffs are very, very widespread, I can assure you, and they're going to be go to 25% at midnight on Friday, which is today for me and tomorrow for you folks. But it'll take a while to bite. But tariffs per se are an evil necessity. Think of the wages that are paid in the States and double those to find the wages paid in Australia, and think of what the wages are in Vietnam, China, etc. There is a reality that for manufacturing industries, many of the OECD countries are just totally non-competitive because we've been so kind to ourselves by paying ourselves decent wages. And, you know, there's the best argument in the world for decent wages. I'm in favour of that. The reality is you finish up, as we've done in this country, Australia, you hollow out your manufacturing industry, all your manufacturing goes overseas because you can't compete in the cost of labour. So there's another thing to think about. So to get this Goldilocks economy, the current administration has been very, very vocal in trying to keep interest rates down. And by keeping interest rates down, the first thing people think of is, it's a smaller expenditure on your borrowing. Well, that's true, but much, much more importantly than that, it's also suppressing the US dollar. And the dollar, since you've actually seen this chart before, I've actually put some marks on it that roughly equate to the terms of the various presidencies. And you can see here that during Trump's position time as president, the US dollar has been suppressed. It's weak. It's every time the Fed even hints at raising rates, they get a rousing bucketing from the president, and he's very open about it. He's wants the market up, wants the stock market up as high as he can get it, and all of this fabulous rally in US equities, it just ties directly to when Trump won the presidency, and he's given very little credit for that. But he's certainly goosed the markets, and the less seen part of that is he's kept the US dollar weak, and intends to do that. And, and that's typical mercantile attitude with the weaker dollar. It makes your exports expensive, makes your imports expensive, and your exports effectively cheaper for an exporting country. That's very good strategy. America's actually biased the other way. It's the biggest importer of goods and services in the world, that's why its dollar is not even cheaper than it is. Okay, so this is the Dow, and I'm showing you here where we are at the moment. This is a monthly chart, a Daniel Code 24-day chart, and this is this pattern that we've been talking about. Here's the hit on the, I'm going to just get the tool to make sure that I can show you this. This is called a spotlight. Here it is. So this is the high that's taken out. Have a look at this. 1, 2, 3, 4 standard deviations from the mean. Markets can't stay up there for long. That's very rarefied air. Down it comes. Attempt to rally back, and look, it fails. Okay, that's the failure point right there. The failure point for the Dow is already in, and it's been in for months and months. Then you get this nice big reaction down to 1 standard deviation from the mean and attempted rally again. But right now, this last bar in here, that's the one that didn't, it made a new high on the sideways chart, on the horizontal chart, but it didn't make confirmation on the angular chart, and that's the tell that the Dow has already got a failure signal on it. Okay, it's a different way of looking at things, isn't it? It's always helpful when you can have a different way of looking at things. Okay, let's move on to the next one. That was the Dow. Let's see what's happening around the world, because the US has a huge bearing on what happens everywhere. But this is the FTSE in London, and it's never really recovered. It's sort of slowly wended its way up and up and up. At times it's held on to 1 standard, it's held on to the median. It's never got above 1 standard deviation from the mean, except for a 10-minute spike back in November 2012, and it's now hit 2 standard deviations from the mean. That's the bad news part, and it's trying to hold 1 standard deviation from the mean. That's a pretty grim picture there for the FTSE. This is the DAX, which interestingly enough is actually the best of all the indices. This is Germany's DAX. Of course, they have a very undervalued currency due to the great trick they pulled with the European Union. The German currency, or the equivalent of the old Deutschmark, is effectively undervalued very considerably against the EU currency. But this was the confirmation move up into here, up at the beginning of 2018, end of 2017. Went back, held support, 1 standard deviation from the mean, just where it did before, now on its way back up to the mean. That's actually a much healthier looking chart than the Dow. This is another one of the Australian dollar, and I'm showing you this because I've been touting this as the weakest currency in the world for a number of years now. I think every new year, when I'm thinking about what are going to be the big trades for the year, I tell you short the Australian dollar. Well, have a look where we are now. This is this break right down to the 67.79 black line. This is that break that happened the day that the Japanese market didn't open when it should. This is early 2019, and it's now testing this blue line in here, which is traditionally these two blue lines have been the last level of support for this currency, with the black line being the do not break this under any. I mean, the government's got some real issues in wanting to have a weaker currency, but it can't let it go down too much, because don't forget, Australia is a net borrower of capital at all times, and if this currency gets too weak, it's going to have implications on the repayment schedules of that foreign currency. But I'm still tipping it as the weakest currency there is, and I'm very excited to see a significant break here, and if it gets down through that support at 67.79, which has got a way to go yet. It's got to get through those, the second of those blue lines first. Then it's going to be great fun to see it in those sort of figures. Okay, now one of the perhaps I should do something strange here. Just bear with me. I see I can do this without causing a monumental problem. What I want to do is I want to show you, first of all, most importantly, more importantly, I guess, than anything, let me show you the Daniel Code website. Big news, we've actually got the 6S results posted. You can see there's a new tab up there saying click here to see the 6S results. This is a relatively new program. We've been running it for you since August last year, live, and these are the results. This is the 2019 year to date. This is to the end of April 2019, and we'll update this at the end of every month for you. You can look at all of your markets and walk your way through there, and that doesn't tell you everything you need. So what we've done is I've given you the figures all the way back to 2015 calendar year. So we've got 2015, 16, 17, 18 calendar year, and the margins as at October 2018, and you can peruse those at your leisure. And further down is some more information about 6S, and there's a little video here of an introduction to 6S and how to trade it. Those pictures, those signals are posted every day. They're up here under this tab, 6S, and if you'd like to have a free trial, you're most welcome. Just click on the free trial box here. Fill in the details. Any problems at all, contact Terry at support@thedanielcode.com. But there are the results for the first 4 months of the year. You can multiply those by 3 to get a rough indication of an annualized figure. Crude oil is doing very, very well. US dollar index is doing very well, considering what a bad market it normally is. Have a look. Here's your last 4 years. Hasn't had a good year since 2015. It's had 3 really poor years, but it's doing great this year. 5,000. If this was to return 20-odd thousand or thereabouts for the calendar year, would be extremely good. Mini S&P 8,000. Say 32, 33,000 for the year. Well, it should be multiplying by 3. I'm sorry, not 4. We've got 4 months of data in here. So 24, 25,000 for the S&P on annualized basis. 21, 22,000 for gold on annualized basis. Natural gas, 15,000 for the year on a pretty small margin. Lean hogs is doing great. I haven't traded lean hogs for many years, but it's outstanding at the moment. Have a look at that. Copper's dead Zododo, we know that. NASDAQ, 12,000 almost so far in the first 4 months of the year, so 36,000 odd for the year. This is not, I'm just multiplying everything by 3 because we've got 4 years, 4 months of data. So that's a third of the year. It doesn't mean it's going to happen, but it's been fairly good previously. Palladium, that's the big daddy of them all, isn't it? Gasoline having a terrific result. 45,000 for the year. Gasoline would be absolutely huge if that held on. Look at the mini Russell, $9,000. You know, it's not that far away from the, well, it's actually doing better than the S&P, and the margin is a fraction of that size. That's why I put it up here for you. Here's the margin. The margin on the Russell was, it might have changed a bit since October last year, $3,700, and the margin on the S&P $6,500. But have a look at this, folks. The Russell is actually earning more than, so far year to date. It's done better than the S&P. Interesting stuff, this, isn't it, when you start to look at it? The Dow's doing well, 9,000. That's the mini Dow. 27,000, something like that for the year. Terrific information here. Do take your time and go through it all. There is so much to learn from all of this. And if you'd like to be trading the success signals, you can have a free trial. You're most welcome. And then when you're ready, just go to the services page, and that will tell you what all of the various things are. You can have a $249 a month website pro. Will give you two Daniel Code 6 Seal Markets free of charge to go that there with you, or you can subscribe to any one of these markets individually, or if there's another market that's not on here that you want to subscribe to, let me know, and if we've got data for it, which we have for almost everything, we'll be happy to add that for you. And as well as that, we've started a new category, $4.99 a month for the works for everything. I know there are some of you who like to trade quite a large number of contracts, and even though we've tried to keep these prices down, once you get past two or three of them, they start getting pretty pricey. So we've brought in a sort of a catch-all super sub for $4.99 a month. You can trade as many as you like, or all that you like. Okay. So let's go back to there. We've got rid of that. Now let's move on. What I'm going to show you now is something slightly different. All of these markets have a point at which they'll fail. And we can actually demonstrate what that point is. What I've got here, this is a program of mine called Fractalian. It's essentially a research tool for this particular test that I'm going to show you now. This is for oil, and it's from Monday, July the 2nd, 2018 to January 2019. I've just picked that 6-month period, so it doesn't last too long, because when you get out to when you get onto multiple functions of the input, we can ask it to have any variable things we like. We can say how many ticks above the true high, true low would optimize your entry, with everyone, of course, thinking the sooner earlier you get into a trade, the better it is. We can change the speed of the period, the timing cycles we're using, and this third option down here is bars since 100. That's basically saying how many bars do I wait to enter once I've got the signal. Is it 1, is it 2, is it 3, or 4? What I'm going to do now is I'm going to run for you just nothing else except our standard settings, but we're going to change the number of ticks. Instead of being 2 ticks above the true high, true low, where we would normally enter, we're saying to the program, test everything from 2 ticks all the way out to 200 ticks, and so that it doesn't take too long and drive you all nuts, I'm asking it to do it in steps of 3 at a time. In other words, don't go 2, 3, 4, go 2, 5, 8, etc. Otherwise, it takes too long. So this is for oil for that 6 months. I just want to show you how this thing works. This program will start spitting out numbers pretty soon. Here it is. It's straight on the job already. And what it's done is in this column here, 1, 1, it's sorting by the number of ticks. So what it said here is all these number of ticks go up because I've asked it to optimize by win percent. Okay, So if we asked it to optimize by net profit, it would say, look at this. The most profitable is not getting in at 1, 2, or 3 ticks above the true high, true low. It's getting in at 101 ticks above the true high or 101 ticks below the true low. Now, there's not a lot of those trades. In fact, for 6 months, well, it's not too bad. It's better than I thought. You get 20 trades and you've got 90% win. Of your 20, you have 18 winners, 2 losers. And we can take this to the next step by asking it to tell us, just let's have a look at win percent. Let's see where these things, the all drop down actually happens. And you can see this group of, from here up, these are all at 100% win. And the smallest of them is 170. It looks to be there. Here we are. Look at these numbers here going up. Yeah, 170. That's the smallest of the large numbers, if you like. In other words, if you were to trade this market for this period and you put your buys and sells, took the normal buy and sell signals that the Daniel code creates, because that's what this program runs on. But instead of buying 2 ticks above the true high or 2 ticks below the true low, if you bought 170 ticks above the true high or 170 ticks below the true low, if that was a sell signal, you would have 100% will. You would have had 20 trades. You would have had 11 trades in the 6-month period, all of them winners, and it would have made $10,000. So it's very selective, isn't it? But you can trade many markets. The trade happening so infrequently, you could be trading 8, 9, 10, 12 markets, and they all show you almost exactly the same thing. But these are what we call the all fall down point, because at these levels, there's 100% failure rate, or effectively better than 95% failure rate. That's the point at which the market is very, very, very unlikely. We never say every time. We never say will or must. What we say is vast probability, but this is showing you the vast probability. It's once the market's gone 170 ticks below the low, it is not coming back. That is the all fall down point. And I've given you that just to show you how I've worked out these figures. We can go back now to our next shot, which was of, not entirely sure we've got here. Did we get here? Yes, we must have. This is crude oil, and you can see it's very hard to see. It's very small. There's so much data to go on the sheet. But you can see that crude oil at 269 ticks. Now, this is either a 3-year or a 4-year scan. I don't know if it shows it to you here. Let's have a look. It's quite small. Trade Saturday. Look, frankly, I can't read. It's too damn small. But what I can tell you is that at 269, this is 3 years, 2016, 17, and 18, and at 269 ticks above the true high or 269 below the true low, you had 100%. Here it is. There's 100% in there. You had 100% success rate. In other words, at 269 ticks either side of a true high, true low, for that 2-year period, failure becomes almost certain. All right, let's move on to the next one. See if you can see it. If I press the right button and blown it up enough for you, you might have been able to see it. Here it is. Here's your 100% return. Here's the dates. From date January 30th, 2015 to December 26, 2017. For some reason, odd dates aren't there. That must have been what was on there anyway. Let's move on. S&P, the same thing. This is from June 30th, 2015 to January 2018 at 146 ticks above the high. More importantly, 146 ticks below the low. That's the 100%. Look at it. That's the all fall down. So we can say with a pretty high degree of certainty what these ultimate failure points are. Okay, it's a very interesting way, is it not, of looking at trading, and something I'm sure you weren't aware of before. So this is the NASDAQ. There'll be people interested in that. This one runs from January 2015 to January 2018. That's the 3 years, must have been when I reset it. And that's got a success rate of, should be in here somewhere. Almost 90%. Almost 90% at 218 ticks. Above the true high, below the true low, 75 trades, almost 90% of them don't come back. It's the best way I can put that for you. I've given you the Dow just for those of you that are interested. You can often hear that, you know, the Dow's down 400, the Dow's down 500, and the commentators get really excited about it. Doesn't really mean much. The point at which it does mean something is 714. And that, to find that number, we've searched from August 2015 to December 2018, so pretty close to 3 years there. And what we found is that at 714 ticks above the true high, or more importantly, 714 ticks below the true low of any daily bar, the market doesn't come back. It has a 100% probability of giving you a profitable trade even further past that number. Quite extraordinary, isn't it? Here's the same thing for soybeans, that we can do the same thing with any market. This is just to show you it works exactly the same on commodities as anything else. It's not just on equities. This is from June the 30th, 2015 to November 2018. And here we are, 100% profit at 131 ticks below the true low. It will not come back. 131 ticks above the true high. It will not come back. Let me preface that again by saying that is the very, very high probability. There are no certainties at all in trading. That doesn't mean that's the best trade by any means. This would have been the better option at 53 ticks above the true high, below the true low. Your profit would have still been very high. You've had a 90% profit, and you'd have made $19,500. But that's for a period from January 2015 to the end of near the end of 2018. So I'm not trying to show you today the optimum trading point, Adrian, rather, yes, I will show you. What we're talking about is the point above a true high or below a true low, which comes within the all fall down definition. So these points I've been showing you, I'll put on a chart so you can see it. Here's Comex Gold, which I know a lot of you are interested in. Comex Gold is a little bit different. We've looked at Comex Gold from December 2016 to October 2018, and we can't find a number that gets past 90%. So 161 ticks above the true high or 161 ticks below the true low, there is a 90% probability in gold that the market will not reverse from that spot. Okay, I think that's the end of those. This is a quick snapshot look at this all fall down idea again. This is actually this is the S&P EMini. This is a 3-day chart rather. Each of these bars is 3 trading days, so it's faster than our weekly chart. And the blue line is the highest high of the last 29 days. And the red line is the lowest low of the last 29 days. And you can see what happens when this market hits red and can't recover and rally away straight away. It's in trouble. It's in big trouble. Okay, you can see it hit red back here. This is the old 2007 high. Recovered straight away, went all the way up to the blue. It happened again down here. Here was the low. It rallied straight away. Looked perilously bad right in here, didn't it? But it rallied from there, got all the way up to the blue. From here on, it's had it. It's running down the red line here. Weak rally, just running down the red line. This is the real drama piece of the whole thing. For those of you who were lucky enough to be trading back in the days of the 2008, 2000, and early 2009 S&P crash was great fun. Okay, let's see where we are at the moment. Have a look. Here's the market. It's up at the blue. It's as high as it can possibly go. If you look purely at a vertical chart, you say this has made a new all-time high. It couldn't be any stronger. I hope I've shown you a little bit by looking at the angular charts. It's not, the picture's not nearly as rosy as it may appear to be. Okay, here's those of you who are interested in doing a tutorial. I'll come back to those who asked the question. We'll look at the charts there. This is from Mick up in, not far away actually, from Brisbane. He's done a tutorial. I've known him for many years. He'd been trading for probably, I guess, 15 years maybe. Had some wins, had some losses, pretty much the standard that most people have until they really learn to trade. He's done the Daniel Code tutorial, and he's absolutely thrilled with it, as you can see. This is from Mick, and I thank you for that, Mick. Most helpful to let other people know how you feel about it. And if you want to be a super trader too, please let me know. I'll be happy for you to do a Daniel Code video tutorial. They're just one-on-one with me and you. And if you'd shoot me an email with your phone number, country and location, so I don't call you in the middle of the night, I'll be happy to call you and we'll have a talk about a Daniel Code trading tutorial, what it can do for your trading and what you could expect from it, and any other points of interest that you have as well. Free trials, if you haven't already, folks, you're most welcome to have a free trial. Click on the free trial link and fill in the form. That will automatically set you up with a free trial, 14-day free trial of everything at the Daniel Code website, including Success and TO3 Plus. And any problems, contact Terry. You'll find him at support at thedanielcode.com, support at thedanielcode.com. Excuse me. Mick D has just said to me, he's on this webinar, finally found the Grail, John. Bless you, Mick. I hope it's absolutely, well, I know it's absolutely fabulous for you, mate, and for everyone else who's done the Daniel Code tutorial. Right, compliance, folks, I always have to tell you that trading is risky. If you don't know how to trade, you're going to lose all your money very quickly. And the safest thing you can do is become a Daniel Code trader. I'll teach you how to trade very, very profitably and safely. Shoot me an email if you'd like to do that. We'll see what else we can show you with here. Now, the question for, let me get rid of this and close that. We're finished with it. So, you were saying, Adrian, you don't know what I'm talking about. This is, let's change this to a daily chart. Here's a daily chart. We'll take the number of ticks that I was talking about, at which we'll get the all fall down point. So we can take this little tool here. This is a high here. We can just drag it down until we get the number of ticks, whatever it is that I've just been talking to you about. Sorry, that's the wrong way. From the low of any bar, the number of ticks that I've been talking about, and at that point you will be reaching the all fall down point, at which there's a very, very high probability that the market goes lower. In other words, doesn't come back immediately. It will come back eventually. Markets fluctuate. But that's the all fall down point there. The inverse would be going up above X number ticks, whatever it was I told you about, from the high, and at that point there's a very, very high probability that the market will keep going and it won't come back in the immediate future. So that's what that's about, Adrian. Okay, let me see, what else have we got here? What other questions have we got? There's that was Adrian. Dow year to date, to see how many ticks it would take to get the. I've shown you that, Suhasini. You've got that. Yes, thanks. Which point or date did you take to make the calculation? It's just running from every daily bar, high or low. Finally found that Mickey, good. Murph, good. Enjoyed that. Thanks, mate. Glad you're with us. Hank, good. Cool here. Cool here. Go and get fired, ready for the night. You're good. Have a good one. It's going to be cool there tonight down the Hunter Valley. Good. Okay, Adrian's got it now. Cool, got it. Okay, wonderful. All right, so thank you for being with us, folks, and thank you for bearing with me. I'm a little bit over time, as sometimes I am. And those of you who are interested in learning almost everything there is to know about trading futures, shoot me an email, jneedham@thedanielcode.com. jneedham@thedanielcode.com, and if you have trouble remembering that, just go to the Daniel Code website, go to the link that says contact us, which is up here somewhere or other, right at the top. There it is, contact us, and there is Terry's contact details, and mine, jneedham@thedanielcode.com. Look forward to talking to you soon, folks. Maddie, thank you, my friend. I'd like to talk to you soon. Take care. Bye-bye.